This episode of Empire is brought to you by Quicknode. Quicknode is an end-to-end blockchain development platform that makes building Web3 apps super easy. No matter what you want to build, you can effortlessly develop any application by leveraging their elastic APIs. Go to quicknode.com, use code Empire. You'll get a free month on their feature-backed build plan. That's right. Go to quicknode.com. You'll get a free month to start playing around. You'll hear more about Quicknode later in the show. This episode is brought to you by Carbon. Carbon is a new DEX on Ethereum that makes concentrated liquidity super easy. With Carbon, LPs can now automate your liquidity strategy with custom on-chain limit and range orders, all from a beautiful UI. Check out Carbon today for unprecedented control over your liquidity. All right, everyone, welcome back to another episode of Empire. We are joined again by Robert Leshner, who has been on the show before, but for a different thing that he was working on now. Robert, you recently announced Superstate, so super excited to chat with you about this. Welcome back to Empire.
Thanks for having me back. Super excited about talking about Superstate.
Yeah. It's a nice name. It's like, Superstate. It's exciting,
Yeah, like in 50 years, we'll have like the Superstate arena, for some sports team.
Yeah, you've been thinking about that. I know you have.
50-year plan.
What sports team would you sponsor?
Probably in 50 years, the most popular sport will be pickleball or an e-sport. So, something like that.
Yeah, you're probably right. Probably right. Are you sad that you have to give up? Are you not playing as much chess now? And I saw you were getting pretty good out there.
There was a while where I was spending like a lot of time on chess. My ratings are going stale and a little bit down because I have not been taking as much time. But, there was a 1-year period where I was definitely learning how to play chess.
Nice. I was complaining to my wife the other day. I was like, yeah, I'm spending way too much time on my phone. She's like, all right, well, let's look at your phone. Like, you can see where you're spending time on the apps. It was like 1 hour texting or like 1 hour on email or whatever. It's like 6 hours on chess.com. She's like, well, this is where it's going.
Well, personal question. What's your rating on chess.com?
Not good enough to be spending 6 hours. I'm a 1200. So
do you play bullet, blitz, or rapid?
So this is one of my problems. I was just playing a bunch of like bullet and blitz games. And so I actually just got a chess coach, and he's like, you got to go to the, 10, 15, 20 minute games to really start to like learn how to play. Right.
That's how you learn how to play. Yeah. Well, that's great. You'll, I look forward to watching your rating, march up over time.
We'll see. Awesome, man. Well, let's chat Superstate. So my like TLDR high level understanding is Superstate is going to buy short-term government debt, tokenize it on blockchains. But would love to hear I think like two things, the vision for the company, but also like the why behind why this is the most exciting and biggest and best opportunity that you can go pursue right now.
Absolutely. So I'll start with what we're doing, and then I'll explain why I think it's so exciting. So, to clarify a little bit, what we are an investment management business that we've created. And we're in the business of advising mutual funds. A few days ago, last week, there was a registration filed with the SEC. It's a preliminary registration statement for a fund called the Superstate Short-Term Government Bond Fund. And this fund is, in a lot of ways, very similar to most mutual funds out there in that it has a very simple investment mandate, and it will purchase a number of securities. And it's it's planning to be a registered and investable mutual fund. What's different about it from other mutual funds is that, as filed in the preliminary prospectus, there will be a component where shareholders of the fund can request to have a record of their ownership sent to a blockchain address that they control, either self-custody or at a qualified custodian that they might be working with. And the advantage of this is that it gives an extra layer of transparency to shareholders in a format that they're already used to. So if you're a crypto venture fund or a crypto hedge fund, you might not want to, create, parallel infrastructure between crypto investments and TradFi investments. And, you might want to just keep everything at the same crypto custodian. And so as an investor, this would give you a tool to be an investor in a very specific mutual fund, but also see it alongside your other investments at a custodian, or be able to track it in a single portfolio management approach, and just be able to like have a unified technical architecture for how you sort of store, manage, and monitor your investments. And so, this is, a distinct advantage. It's not a massive advantage, but we think that it's really, the first step on the, tokenization or digitization, whatever you want to call it, for what many people call real world assets. I just call them, traditional assets in a lot of ways, but bringing a traditional asset or traditional investment on chain in some capacity. And this is like chapter one of like, as a whole society and a whole industry, this shift of bringing assets on chain. And the advantages long-term of having assets on chain are numerous. There's a composability with other on-chain systems. There's, a massive increase in transparency, in automation, in the speed and, permanence of settlement. Like all of the reasons that people love DeFi, are eventually going to exist for traditional assets. Traditional assets like mutual funds, stocks, bonds, currencies. That is the end state. And, what we're doing is we're doing our piece, a very specific, narrow piece to usher in this future. And, when I look at like, why are we doing this? When I got into crypto in 2017, at the time I was like, oh, real world assets and tokenization of things is just around the corner. I said, to everyone who would listen to me, like
security token summer of 2018.
Yeah, exactly. Of 2018. I was like, oh man, like we're just like one step away from like all of the bonds and all of the equities and all of the currencies and commodities and real estate being tokens on a blockchain one day. And 6 years later, we've seen very little demonstrable traction and proof of assets coming from traditional markets onto the blockchain. And, I view this as one of the single largest opportunities for, the blockchain ecosystem as a whole, for investors, for developers, for builders, is to like just assist in the process of bringing assets on chain in whatever way is, feasible and possible. And that's the sort of why, I just view this as a massive migration that I thought would have happened by now. I thought, if you asked me in 2017, like, how long is this going to take? I would have said like 5 years, everything's going to be on chain. A protocol like Compound or Uniswap or MakerDAO or whatever is going to be able to interact with like commercial real estate, but like none of this has occurred yet. And so, that's the why. I just see this massive migration that really hasn't started. That's been lagging. That like for the builders and developers in, the crypto ecosystem, like I thought other people would have made more progress by now and more traction by now.
Well, why do you think that hasn't happened? Because actually, there are a lot of folks who have tried to take this on, right? Do you remember Harbor? There's like Josh and Harbor, and I think Bitco might have acquired them back in the day. There's obviously folks like Securitize. Like there have been people who have been working on this and kind of attacking it from different angles. Like a lot of folks trying to tokenize real estate. That obviously hasn't worked out so well. Like, why do you think the kind of securitization platforms of the last 5 years haven't worked out that well?
Yeah, it's a great question. I think, a couple of reasons. One is, it's been relatively early in the sort of growth of demand. It's a chicken and an egg problem, but there has to be demand from end users to have things brought on chain, or a giant economic invisible hand that's like, pushing them on chain or pulling them on chain. Like there has to be some like massive driving force that like wants it really badly. And, that's, I think, the most important piece. And I think like the invisible hand of like wanting, securitization and tokenization over the past few years has not been that strong in comparison to assets that are issued native to crypto. So assets that only exist on a blockchain. So, I look at the world very simply as like a black and white thing of like, is the asset originally created on a blockchain? And is that the only place where it lives? Or does the asset exist in the traditional financial market and it needs to be brought onto a blockchain? And all of the most popular crypto assets for traders in crypto, for hedge funds, for venture funds, for whatever, are crypto native assets. It's the assets associated with a layer one blockchain, the assets issued on top of a layer one blockchain, and all of these things. And it's just so much easier and closer for these crypto native assets. And so, there's been enough of a market for crypto native assets. That's been where all the excitement is, that you haven't really seen, a huge amount of demand for like, okay, we need to get, stocks onto the blockchain, or we need to get real estate onto the blockchain. There's a huge amount of interest, in crypto native assets. Like, you look at anyone, you ask them what they're excited about. They're excited about crypto because it's different than, real estate or equities, which they already have access to. They like the thing they don't yet have access to that's new. But I think over time, that pull or that gravity is going to increase, especially as the amount of things you can do on chain increase. And so when I look at this, I think the invisible hand is biggest right now, and probably for the next few years with, short-term interest rates. I think like the biggest pull is going to be people who are on chain, who are native to blockchain, saying, well, we really want the yield from TradFi. I mean, like T-bills are 5% plus. Like, who doesn't want that? It's one of the greatest assets of all time. It's, an incredibly safe short-term investment. And so, everybody wants that. And it doesn't really exist on chain right now. There's a lot of, teams out there that are developing solutions. We're not alone. We're not going to stay alone. There's going to be, 100 like phenomenal teams that are all trying to, facilitate what I think the invisible hand wants, which is like, how do you get this great investment from the traditional market and bring it on chain where I can use it in interesting ways. But like, that's where I see the invisible hand being strongest, is around rates. And mostly because, the interest rate differential between, TradFi and DeFi right now favors TradFi coming on chain. Rates, that are scalable into the trillions right now are like 5% zone. Rates in DeFi across the board are not. They're like 2, 3, maybe at best 4%. And so, it's the time for there to be a giant magnet pulling assets from off-chain on-chain. The opposite existed, 3 years ago, where like rates in DeFi were like 8%.
Yeah, it's the inverse of DeFi summer. Yeah, exactly.
It's the inverse of DeFi summer. And TradFi was 0.
Yeah. Yeah, it does feel like there's this huge market like space right now to smooth out the kind of the proverbial like interest rate gap between Web 2 and Web 3, or traditional capital markets and DeFi.
Absolutely.
Before we get there, because that's actually really interesting. Before we get there, I interned at oh my God, what was the name of this mutual Capital Group, American Funds, which I guess is like a one of the biggest mutual funds out there, competitor to the Vanguards and Fidelities of the world. There are kind of two angles I feel like you could have taken here. One is basically trying to recreate Vanguard's business, or maybe Franklin Templeton's business, and do it more on chain. Another angle that you could have gone here is to build a platform to help the Vanguards and Fidelities and Franklin Templetons of the world come on chain. Which direction did you go, and why?
Yeah, that's actually a really interesting question. So there's definitely technology companies that are trying to enable investment managers to come on chain. We're in bucket one, or the first approach that you described, which is we're creating an investment management business that will be technologically savvy. I have a lot of experience in, on-chain markets, but that's an investment management business first. So it actually looks a lot more like a Vanguard that's going to make more high-tech financial products. Not a technology company trying to level up, Vanguard and BlackRock. And so, I view Superstate, the business that, we recently launched, as something that eventually over time will slowly compete with Vanguard, BlackRock, and investment management businesses with, like a tech focus to create, just like huge amounts of funds that people prefer because they're, slightly more functional and higher tech and, more transparent and better, and, all of these advantages.
Huh. It's interesting. I never really thought about like that business as being like a business to go into. But I guess if you think about it, a lot of these are kind of like legacy family run businesses. Like I think Capital Group is still private, started a long time ago, still private run, like family owned business. I think Fidelity is the Johnson family, right? Has been running it for a long time. Franklin Templeton, I'm pretty sure, family run business. And I never really thought about going after these businesses, but that's interesting.
Yeah, there's not many people, trying to think
It's the
about
less
that.
sexy thing, right? Because you could have raised a bunch of money for a tech platform at a really high multiple, even in this market, I'm sure. So
Yeah, I think boring is sometimes good.
boring's
We're
great.
basically we're basically trying to like fill the shoes
As
of.
someone who did not start a DeFi protocol and had some FOMO in the DeFi summer, boring ended up being pretty good.
Yeah.
Tell me more about like the types of assets that you envision tokenizing, because I think like when people talk, by the way, I like that you called them traditional assets, not real world assets, because I think real world kind of implies that, I mean, things digitally is not the real world, but obviously that's not true. So I like this word traditional assets. Tell me what you are starting with, and then maybe like how you expand to other traditional assets, and like which ones you kind of take on first.
Yeah, it's for me it's relatively obvious, which is I think the biggest pull and the biggest demand is going to be around a safe short-term interest rate. There's trillions of dollars that are looking for short-term yield that aren't trying to chase risk or duration. A short-term government bond fund is like the lowest hanging fruit. It's the juiciest apple that's closest on the tree, and it's like the most obvious candidate. Mostly because I think the market for it is massive. I think there's potentially trillions of dollars of incremental interest in short-term government debt, and so that one's obvious. Down the road, we're going to explore additional asset classes, but not until we've proven out what works, what doesn't work, and iterated with a single asset. Because I think it's like the most important asset. It's the most obvious, and it's too early to be like, all right, well, if a short-term government bond fund works, what about an equity index fund or, a commodities fund or a real estate fund or a currency fund? Like you can create a fund for any asset, any strategy. I mean, there's, a trillion different funds you could create, but we're just going to start with the most obvious before spending the time and focus and bandwidth on, what else is potential.
Yeah. I guess there's I remember actually Pomp always saying his like a Pompism back in like 2018 or 2019 was like tokenize the world, and he was like, I remember him always saying like stocks, bonds, currencies, commodities, it'll all be tokenized. What in terms of like difficulty, I'm maybe on more of like a micro scale. I'm actually very curious like how this kind of works, like what you have to build to maybe tokenize something like equities or commodities. Like how does that actually work?
Yeah, it's a great question. I mean, fundamentally, it's actually not very different from, having a bond fund where the shares can exist in a digital record on chain. If you can have a fund and the shares exist, on chain as a digital record, it doesn't really matter what's in the fund. It could be bonds and cash. It could be stocks. Theoretically, it could be real estate. It could be anything. It's really not incrementally different. I think the most important thing, and I'll keep going back to this phrase, is just like, what does the invisible hand want? Like
the interest rates. Yeah.
And I think that's like what's fundamentally different. I don't know how many people really care about having stocks on chain right now, because they can get stocks off chain and they may as well.
What's kind of like the second order impact of having traditional yield, like 5-6% yield or whatever in DeFi? What does that do for DeFi, and what does that do for crypto?
Yeah, it's a really interesting thought experiment. I mean, if you have like a huge amount of yield opportunity, coming from traditional assets but on chain, and the switching costs are low, I think eventually what that does is just crowds out DeFi up to that interest rate. Like if it's incredibly easy to get T-bills on chain and they're 5%, I don't think people are going to, be comfortable with an on-chain return less than that. And so like, the equivalent like risk-free rate in DeFi will go up, and the, available interest rates in DeFi will go up beyond that. It's just that right now there's so much friction between, off-chain markets and on-chain markets. Like there's back and forth costs, there's, switching costs, there's like opportunity costs. If you actually have at scale and without too much friction, the risk-free rate on chain, everything else is going to have to like match it in its equilibrium. Like no one's going to, take incremental risk there when they're like, oh, well, I can instantly get 5%. And I know it's just T-bills. Like that's awesome. Like how could any protocol or any system offer less than that? The only reason they can right now is because there isn't some scalable on-chain access to a low risk liquid investment.
Okay. So then does I've been thinking about like I've been reading about LIBOR recently, trying to understand LIBOR and just think about like what the risk-free rate in DeFi will look like in a couple of years. On one hand, you could think of it as like almost the yield that staking spits off could be the risk-free rate. But on the other side, you could think of it as like the 10-year treasuries, right, are about as risk-free as you can get. So like, how do you think about the yield that you get from something like 10-year treasury being tokenized versus the yield that you get from staking?
Yeah, it's really interesting. Okay, so for a given currency, there's going to be some essentially risk-free rate. Okay, the word currency and commodity are kind of squishy, but like for Ether, there's a risk-free rate, but Ether is different than dollars. Dollars have their own equivalent risk-free rate. For Ether, it's staking, right? And that might be 5%, but the exchange rate between Ether and dollars might be incredibly volatile. There might be a risk-free rate for euros, which matches, like the ECB rates on chain, but Ether is its own sort of like currency or like base level asset. 5% in Ether is not comparable to 5% on dollars because dollars are flat. They don't really do anything. They're sort of like a straight line. Whereas Ether goes up and down in dollar terms 3% a day. But if you're like completely like, I am an Ether maximalist and I only think in terms of Ether, Ether's risk-free rate is all that matters to you. And a rate on dollars is the risky one because that one's going up and down in Ether terms all day. And so it's subjective in the same way that like the interest rates on any currency are subjective to the people, exposed to the local currency versus being a foreign currency. And, there's preferences, but, there's not one risk-free rate. There's a risk-free rate per currency. And for Ether, it's going to come from staking yield. And for dollars, it's going to come from T-bills as all of these, things reach, scale and parity.
Huh. That's really interesting. I imagine some of your, like, how do your learnings from Compound apply to what you're building right now? Because the rate on Compound varies widely, right? Which leads to like interest rate volatility and which comes from like just kind of full free market, full decentralized free market. And which has some problems, right? It limits some things that can happen. And we don't have a fully baked out like interest rate swaps market in DeFi yet, and people are working on that. But how does like your learnings from Compound specifically applied to interest rates apply to this?
Yeah, it's a great question. So, the first lesson that I learned probably around like 2018, 2019, after like the first like version or two of Compound was released, was that for the most part, almost all of the demand to borrow was in stablecoins. When I originally envisioned Compound and like wrote the first white paper in like 2017, I was like, oh, people are going to want to borrow every crypto native asset that exists. Like people want to borrow Ether and people want to borrow, Chainlink tokens. And the reality is that people really just want to borrow stablecoins or, a stable asset because, they prefer that their debt isn't uncertain, right? They don't like it going up and down wildly. They want to borrow something where they know exactly how much they're going to owe. Borrowing in stablecoins has been like the overwhelming preference for a lot of users that I've been able to observe. And, that was the first like major lesson. And that actually informed, a lot of the decisions that went into the design of like Compound version 3, which was like, well, what if we just like remove half of the protocol and you can only borrow a stablecoin? And like what happens if you just like rip out half the code? And it led to like a real like, reinvention of just like thinking about, what do people want, whether it's like a crypto hedge fund or a high net worth, speculator, like what do they actually want? And like, can you like rip out all the things that they don't want? And from an interest rate perspective, one of the things that surprised me is that, fixed rate instruments haven't taken off in DeFi yet. I was expecting, from the earliest days that fixed rate markets would have taken off. I've, as an investor at Robot Ventures, invested in like 10 different protocols that do fixed rates. Um, we still haven't really seen any markets or any products that do fixed rates like really scale in crypto yet. There have been a lot of incredible experiments. I'm really excited about a lot of teams working on this. But like, to your point, like the rates that actually are there, like Compound, Aave, Curve, whatever, these are rates that change, block by block. These are not termed rates really for any structure.
Right.
It doesn't allow users to like, take a lot of like rate predictability. And so, this has been a surprise to me. And like, that's a lesson, is that this is a surprise that it hasn't developed and hasn't grown at all. And so, I think it like lends more credence to the idea that like, things will just exist in their most scalable equilibrium format. And there hasn't yet been a large amount of demand for a fixed rate on the borrowing side or interest earning side.
I think it kind of just clicked to me that the opportunity here is not with actually individuals, but it's with companies, right? Because like people are flexible when they get their mortgage, right? Like some people want fixed rate, some people want variable, whatever, different pricing, et cetera. But if you were a company taking out a loan, like if you got a variable loan, that could crush your business. And so like companies don't basically borrow on chain right now because of I think one of the many reasons is because of the unpredictability of the interest rates, which can completely crush a business. But actually, like thinking about it with treasuries, like Blockworks right now is looking into kind of like, you get 5% if you just put it in 10-year right now. So like, what do we kind of do with some of the money in the bank account? And it feels like the huge opportunity right now, which is like the $1 trillion opportunity, is actually with treasuries. And I'm curious to hear just how you think about like treasuries being the opportunity. Yay or nay?
I think yay. I mean, clearly
Okay.
I'm making the bet on yay,
Yeah.
what I'm spending my time on, right? And I think to go back to our earlier moment in the conversation.
But I guess like, is that the end customer? Like, is the end customer here, when you think about your customer for the business, is it a company tokenizing or allocating their some of their treasuries to get this yield?
In 50 years, potentially, in 20 years, in 10 years, right? I think most companies, if they're looking for, a stable investment and like they're not already crypto native themselves, like they can go out and buy, a 10-year or 5-year treasury bill or note today, right? They can just go out and buy treasuries. Like they don't need any product that exists in crypto. The question is, do they want to do that, on chain or not? And the answer is on chain. Increasingly over time, the answer is going to be yes, because more and more businesses and more institutions and more users and investors, et cetera, will be, capable of interacting with blockchains and accessing blockchain-based markets and services. And so, as people come on chain, they're going to want that 5%, note on chain. They're not going to want it through, a traditional, Web 2 or, Web 1 stack. They're going to want it at a Web 3 stack. But, today if it's just about the investment return and like the liquidity profile and all of this, they don't have to buy an asset on chain. They can buy an asset. There's a million ways that you can go out and get those treasuries right now.
All right, quick break from the show. There is this kind of overused cliche saying in crypto, but it's true. Bear markets are building, and everyone tells you that and everyone knows it. What people don't know is that if you're building apps in crypto and building apps in Web3 without using Quicknode, you are building on hard mode. So Quicknode is this amazing blockchain development platform. It reduces costs, streamlines the time to market for your app, and it offers consistent performance at scale. For folks that have built apps, you will know that there are a couple key points here. One, Quicknode offers unlimited endpoints across 18 different chains and 35 different networks. They have response times that are 2.5 times faster than any of their competitors, 99.99% uptime, and a dedicated 24/7 customer support team. If you've been listening to Empire for a while, you might know that I am no Gigabrain developer, but I do know a lot of devs and a lot of great product teams at other places. So when I see Coinbase and Twitter and Adobe and OpenSea and Dune Analytics all leveraging and trusting Quicknode to power their business, that's when we get excited, and that's when we want to partner with them. They're the best solution for any leading crypto and Web3 company that is seeking an end-to-end blockchain development platform right out of the box. So my message to you, get off hard mode, let Quicknode handle the blockchain infrastructure, let Quicknode handle the security, let Quicknode handle the performance while you focus on building beautiful products for your users. Visit quicknode.com, super easy. You can use code EMPIRE. You'll get a free month on their build plan. So don't forget to use code EMPIRE. Santi and I got to get credit for this one so they know that we sent you, and you will get a first month free. Hope you guys enjoy it. Let's face it, concentrated liquidity is hard. And that's why I'm super excited to partner with Carbon for Empire. Carbon is a new DEX on Ethereum that makes concentrated liquidity easy. With Carbon, LPs can now automate your liquidity strategy with custom on-chain limit orders and range orders. Want to buy a token when it dips and sell it when it spikes? With Carbon, you can now set a strategy that buys in on one price range and sells in a higher range on repeat, using a single source of automated rotating liquidity. Strategies can be created for any standard ERC20 token. I recently checked out the Carbon beta that just dropped. Pretty blown away by the liquidity strategies that Carbon enables on-chain. It has these rich trading features that you'd expect from a centralized exchange, except Carbon is fully on-chain, decentralized, and non-custodial. Just connect your wallet. It's carbondefi.xyz. That's carbondefi.xyz. Choose a trading pair, set your buy and sell ranges and amounts, hit create, and you're done. Carbon automatically moves your liquidity into your selected ranges as the market moves. Last but not least, I'm excited to announce that Carbon is running a ROI trading competition until July 11th. Here's how to play. Super easy. 2 steps. 1, click the Carbon link in the show notes. 2, create a new Carbon trading strategy. And voila, you are now eligible to win USDC rewards based on the performance of your strategies. LPs, it is time to take back control of your liquidity with Carbon. Check out the link and get started today. Now, let's get back to Empire. Pivoting a little bit, I'm actually curious on the fundraise. I noticed that you guys only raised from, I think it was 5 or 6 folks. I think it was Parify, 1KX, Cumberland, Coin Fund, and Distributed. I'm pretty sure it was.
Yep, those 5.
Why the basically like what? I mean, you were also run your own fund at Robot. Like, why not? There's a different strategy here, which is you go get every crypto fund. I'm sure they all would have allocated. You go raise, how much did you raise? 4
million. Yeah.
You could have raised you could have 10x that. I bet you could have raised 40 million.
I probably could have.
Right? You could have raised 40 million. You could have got like 50 of the best crypto funds. You probably could have gotten some traditional funds on board. Why didn't you do that?
Well, I think, it's a really interesting question. I mean, we really wanted to optimize for getting firms that we already knew and who we think would be, ideal users and, customers and, participants over time. I think at some point we will go out and talk to all of the rest of the crypto funds and do something larger, but early on we just wanted to optimize for making sure that we had, exactly as much capital that was needed to get this off the ground. And, we've really just optimized for something simple and straightforward. Where we didn't have to have a lot of conversations. And so, it's likely that maybe we will go out in, a year or whenever and, try to build a really close relationship with a lot larger of an audience. But it's just something we didn't do at this sort of pre-seed.
Nice. Cool. If Franklin Templeton or Vanguard or Fidelity wanted to put in a big chunk, would you let them, or is that a competitor now on your cap table?
Yeah, that's an interesting question. I mean, I haven't thought about it. Over time, I think like the lines of like what's competitive and what's cooperative like evolve considerably. Like one of the things I've seen, not just from crypto, but many different industries is that things that look like competitors are eventually collaborators and like cooperative, and things that look cooperative are eventually, competitive. And so, I actually think it's generally okay to take strategic investments as long as there's no, separate terms. One of the things I've seen actually harm a lot of companies are when strategic investments come with like incredibly restrictive like covenants or side letters. And I'm saying this as an investor and as a founder with lots of friends who are founders. if it's just capital, then it's actually great to have, whether it's cooperative or competitive, like the industry on your cap table. But the problems really arise when it's, coming with like all these extra terms, oh, we get a first look at any M&A activity,
right,
or like we have a right of first refusal on M&A, or like, oh, we need additional like management rights or information rights versus all of your other investors, or, oh, we need to be able to see your products before they launch. Like all of these things that are not purely capital based can like only harm a company and make it less successful. And so, my advice to any founder out there is like, if there's a strategic investment from someone in the industry, it's actually like probably a benefit to both firms, like if it's just capital based. But if it comes with like lots of like weird, clauses that like limit your own business, it's going to be a negative. And so,
which if it comes from a corporate VC, it usually does. And
so if you can do it without, the complexity, like you should. And so I would say like, if, down the road, we were able to take investment from someone like, a BlackRock or a Vanguard or a Fidelity, and it didn't come with, restrictive, behaviors, then it's beneficial to both firms.
Yeah. All right. Going back to what you're building for a second, just kind of, I've one more question that came up on the interest rate stuff. The yield curve, right? So like the yield curve in economics is like central to the transmission of monetary policy. And we don't really have a yield curve in DeFi. I'm assuming what happens is like you push into like treasuries and then munis and then like investment grade stuff and then maybe high yield stuff. And this combined with interest rate swaps creates this yield curve. Is that the vision here? And like, maybe tell me about your vision and how it relates to kind of building this DeFi native yield curve.
Yeah. So, my vision really starts with just like doing what I think is like truly the biggest opportunity, which is short-term government debt. Because short-term government debt, there's so much demand for it. And fundamentally, it's an incredibly healthy product, right? The investors in a short-term government bond fund are not going to lose money, like unless there's like some like one in, black swan situation.
Ask the Bitcoin maxis. They might disagree with you, Robert.
Okay, that's true. To the Bitcoin maxis out there, we can debate this on Twitter. But it's an incredibly healthy product. And in general, you're like not going to lose out really against inflation. And it's like long-term, like a great product. And it's the perfect product to sit at the base of, the product cycle and the yield curve. As you talk about all these other things, it's just, investment decisions on what you want instead of the risk-free rate. Like, and there is risk in all of them. And, there's a market for all of them. In fact, there's a huge market for every single one of them, massive. But they're not as simple. It's very simple to think about, short-term government debt, because short-term government debt is just one of the healthiest possible products. And, it never hurts to put people into it.
What about the regulatory side of all this? I think I read that you guys are going to have to whitelist anyone who holds it. So I'm like, that's almost like a moral trade-off, maybe potentially. Like, how did you think about this?
Yeah, it's a really fascinating, set of trade-offs. There's, I'm sure, ways to make products like, stablecoins like USDC and Tether, where like they're not whitelisted or permissioned in any way. Anyone can hold Tether, and there's, no checks. There's no, KYC, AML, OFAC. There's none of this stuff. There's ways to make those products. And I think there's a lot of people that are going to benefit by making those products. I kind of see a world in which 10 years from now, what does DeFi look like? It's an amalgamation of assets that are permissionless and permissioned, and that they coexist in the same protocols, in the same markets, in the same, entities. I mean, you could have a protocol where Aave or Compound, where you have assets that 1 billion people can access and 8 billion people can access. And it's just they're under the same roof, but you have ways of sectioning off certain assets. The reality is we're taking a path which, by filing a prospectus and creating, a product, it means it's going to be available to U.S. investors and investors with U.S. addresses, which is awesome. But it it also means that you have to verify in some fashion that someone is a US investor.
Yeah.
And, this is necessary for so many different reasons. It's for AML, it's for tax, it's for compliance, it's for just like market integrity. Like, you do have to know who the shareholders of a registered mutual fund are. And that's not a bad thing, right? There's a huge number of people that can hold that asset. There's a huge number of people that can hold that asset. It's possible over time there's products that are only for offshore investors. And then you have, a product that's for US investors and you have a product that's for non-US investors, and they both exist. These are just the choices that get made. And, from where I sit, I think it's actually really exciting to go down the path of building a product that US investors can purchase that, has been registered in the US. It's not easy, but I definitely think it's something that, opens it up to a really cool market. And, we're going to be able to have a system where, yes, people will have to onboard in order to hold it, but there's going to be a lot of reasons to onboard, in that you're going to be able to have something that at the end of the day will eventually be, a really healthy investment that you can hold on chain, that is useful, and, you're incentivized to have it over, let's say a stable coin that just gives you 0% and burns a hole in your wallet until you say like, hey, how do I exit this thing?
I think one of the last things I'm curious about here, Robert, is on the stablecoin front. I'm curious how I think I saw somewhere that you were either saying that this will compete with stablecoins, or maybe I saw someone else posting about that. But how do you think about stablecoin competition? And maybe the better question is like 5 years from now, Superstate versus USDC, like competitors, enemies, frenemies, like what does that look like?
Yeah, it's interesting to think about, because I think that, between products over time, stablecoins and investments are going to run into each other for users, for capital, for use cases in general. And I think the reason why stablecoins are so dominant right now is because there's very few alternatives on chain. Stablecoins are a really positive product. I mean, they are the first product besides crypto native assets like Bitcoin and Ether that have like absolute product market fit. It's why we've seen stablecoins go from $0 to $130 billion plus in a short amount of time. Stablecoins are crazy useful because they settle instantly. They're super portable. They're programmable, and you're able to self-custody them. And so like as an asset, that asset is just better than cash in so many ways. And so like there's huge amounts of product market fit there. But the environment behind stablecoins is getting worse and worse. So when rates were 0, stablecoins were the greatest thing imaginable. When rates are 5%, stablecoins are not a healthy product. They burn a hole in the wallet of anyone holding them. They burn a hole in any corporate treasury. They burn a hole on any balance sheet that they're held. Because right now the sponsors of stablecoins are, earning 5% plus, keeping 5% plus, and giving the holders of the stablecoin 0. And this was fine when rates were 0.5%. Who cares? But when rates are 5%, the sponsors are getting incredibly wealthy at the expense of the holders. And that's going to change. And the reason why that's like tolerable right now is because there's very few alternatives. It's very hard to convert the stablecoins back into dollars and then go out and do something with them. That's why stablecoin balances have stayed shockingly high, even as rates have gone up. But when there's alternatives that are easily accessible to crypto native investors, then I think there's going to be a war between traditional investments and stablecoins. And right now that war is incredibly lopsided. There's almost no traditional investments available to crypto native investors. It's slim pickings. But when they're readily available, I think that's going to be one of the primary battlegrounds, is looking for like, where does capital choose between a stablecoin and an investment product that, they can use on chain, right? And when they both exist, I think there's going to be a competition between the two. The other competition that's going to exist, for better or for worse, between stablecoins and investment products is that, stablecoins still are on a, no KYC AML bearer model, right? Anyone can hold them, whereas investment products are going to have a narrower
Yeah.
ownership base. And so I wouldn't be surprised if in like 10 years, there's $400 billion of stablecoins and like $200 billion of on-chain investment products. Like that wouldn't surprise me either if like they both continue to grow. And it's just like, hey, if you're not within this, known perimeter, the returns suck. And if you're within this known perimeter, the returns are what they are supposed to be. That wouldn't surprise me either.
Yeah. And will you be able, so there's going to be a token, like what's the token, like, SSTF or what's it going to be called?
Oh, I don't know yet.
You don't know? Okay. Well, so I'll make it up. So, all right. So the Superstate token, will you be able to put that, will you be able to trade it in things like Uniswap?
Not at launch. No.
Not at launch. But eventually you want to basically create these like white labeled pools, I'm assuming, inside of the compounds and Uniswaps of the world.
Well, it's a really hard problem because, for a fund has to actually know who all the shareholders are. And when assets go into a pool like Uniswap, you start to lose context on who the actual owners are, right? If there's 10 LPs in a Uniswap pool, right? It's hard for the fund itself to even know how many shares each person has, right? Especially like look at Uniswap V3. People have different, liquidity ranges. Like when the price has moved $1, how much do each of the underlying LPs even have anymore? Like it's an incredibly hard problem. And the reason it's necessary to like understand this, besides like the first piece of like, oh, okay, like can we make sure that North Korea isn't one of the holders of it? That part's honestly quite easy to like make sure North Korea is not a holder. The harder part is just saying like, hey, we have to issue like 1099s and like essentially P&L. Like you really have to know when each shareholder has acquired and disposed of an asset. And if you can't do that, then like it's just mechanically like impossible to operate. And so I think what's going to happen is over time, the development cycle is actually going to go in like a different circle. So you're going to get investment products, and then DeFi platforms are going to have to reinvent themselves to accommodate them. It might require small changes to protocols. It might require like medium changes to protocols. But like I actually think the opposite happens. It's not like, hey, we're doing this asset, it's going to go in Uniswap and we're going to figure out how to make it work. It's going to be, here's how we have a compliant product that's able to, handle taxes correctly, and it's able to handle KYC, AML, OFAC correctly, and all of these things. And then like, what does a protocol need to do to actually make those assets able to be used in the protocol? Because right now, frankly, like,
oh, interesting.
I don't think Uniswap V3 actually would work with, a fund.
I have a product idea on this front. Tell me tell me why this is a bad idea. One, what if you could create like basically a KYC AML protocol, and once you go through KYC AML, you just get a what are the non-tradable soulbound token or whatever you want to call it, a non-tradable NFT that just sits in your wallet. And then when I go on Uniswap, it also sees that I have this soulbound token that's like the KYC token. And only for people who have that, they can trade the Superstate funds. Good idea, bad idea?
Yeah, so it's actually really interesting, the idea of having like a global sort of like KYC system that like many different issuers or protocols could hook into. The approach that we're taking is that, the fund admin and transfer agent and a investment advisor, which is like us and service providers, that's who you're actually providing the information to. You're really providing it to the fund admin at the end of the day, which is going to be a very traditional Wall Street entity. They're the only ones who are going to have the information of the shareholders. It's not going to like live on a blockchain being like 0x123F2 is, Yano, like that's not going to like live on the blockchain. Jason's information isn't going to be on chain. It's going to be with the fund admin, and the fund admin is like, okay, well, like 123F, 4s, is Jason, whatever. The other sort of difficult piece with that product idea is, you don't want to expose the information, but each of the people that are like using the whitelist kind of have to know who it is. They can't just be like, oh, Superstate signed off on their KYC, therefore, like, you know, people can like use our platform. It's like, because if like a regulator goes to them and says, okay, well, who's user 123FD? They'll be like, I don't know, like, go as Superstate, but it's not like our product, right? It's not like our, you know, thing that you're using. So it just like creates this like information imbalance that like makes it hard to have like one global whitelist, because it's like, where's the information even live? And so I think the best approach in the short term is just like, hey, you can onboard with this fund admin. The fund admin knows you and can say 123, you know, FD is, you know, approved to be able to hold this asset. But no one knows on chain who 123 FD is besides the fund admin. The information is not exposed. You can hold the asset. You can transfer it to another shareholder. You know, high five, everything just works. You know, getting into systems where many different projects or products or systems share the same whitelisting system just starts to get like really complex. And I think someone's going to do it. Like, honestly, in like 10 years, there's so many smart people out there. In 10 years, someone's going to figure out how to have a zero knowledge proof based system where you can prove that you're not North Korea and the whole thing just works and it's interoperable and every DeFi protocol can have it for investment assets and like, you know, crypto native assets, like without a whitelisting, just continue to work like that. And like the whole thing just goes together and it's perfect and users love it. But that's like,
chef's kiss. Voila.
Chef's kiss. That's a mile away. And so like, if you see those projects, like, let me know. I'd love to invest.
I got you. Business model here is just fee model, right? Like, you
it's
know,
fees. Yeah,
25
it's so
bips
simple.
on. Okay.
Yeah, it's going to be 33 bips on the fund that we filed a preliminary prospectus for. It'd be great if like bips. Over time that comes down to be more competitive with Vanguard and things like that. But it seems like a pretty competitive fee to start.
It's actually a beautifully simple business. I wish Blockworks had just one simple pricing. Like that's a beautiful business. But it's also a tough business because it's a very small amount of money, right? Like if you get $1 billion, I think this mental math is right. $1 billion on 33 bips, that's $3,300,000.
That's right.
So I guess you're just betting that like you will have 200 billion, right? Not.
That's the goal. The goal is over time to be competitive with BlackRock, right?
And to 200 billion on 33 bips. What is that? That's 660 million. All right, that's a nice billion.
Per year is like cash flow. Yeah, it's a nice. That's a great business.
Yeah, fair enough. Awesome, man. Anything we missed on Superstate?
I think we've covered pretty much everything.
Cool. You're excited to be back in the early stage, like day one days.
I'm like a 0 to 1 guy, and I'm also like a 1 to 10 guy. I'm not like a 10 to 100 guy or like 100 to 1,000. Like I actually really like the early stages a lot, because it's like bringing something to life that hasn't existed before for me is like really fun. And like beyond that, I love growing something. I love like taking it from like, hey, there's usage to like, hey, there's a lot of usage. But I think there's people who are better at like, hey, there's a lot of usage. How do we get it to crazy usage than me? And so I love the early stage. It's what I love as an investor. It's what I love as a founder. Yeah. You know, just like, you know, what do you have to do to bring something new to the world that should exist, that like users want, that regulators want, that like, you know, composable, you know, businesses and protocols want? It's like, how do you just like usher it into being? Like, that's so fun. And like, that's what I'm really happy to be doing again.
Yeah, I'm excited for you, man. What did you find to be the toughest thing about running a company that had gone into what I'd call like that third stage? Like I don't know how many employees you guys had, but like it was definitely past the 10 employees, like 30 or 50. I don't know how big it was, but
yeah. Well, it's interesting because like my focus for the last like couple years at Compound was on a product called Compound Treasury, which you can start to see the parallels between.
Well, it's funny because when I saw this, I was like, oh, he's been trying to do this, but it didn't. It was like square peg round hole inside a Compound. So
yeah, square peg round hole. So like my focus was on Compound Treasury, which was a product for institutions. That the idea was like, you know, you could have a DeFi protocol and then you would have a layer on top of a DeFi protocol.
Right.
And the institutions could interact with this layer on top of a DeFi protocol that was like, you know, had a regulatory framework and like they could get the benefits of DeFi without using it themselves. And it was a really cool idea, like, to be honest. So, like, I actually thought it would work. And like, we actually got like 33 really cool institutional users and customers for the product, and it was starting to scale and growth was great. And then CeFi blew up. I mean, 3AC, Genesis, Celsius, FTX, like all these BlockFi, a bunch of other ones. It was like everybody who was in the business of like, give us your money, like trust us, like we'll make it work correctly and safely, like proved that like that model like was like not going to work. And it was really frustrating because we spent like 2 years or so building up like a really cool product. And like, it was the first product in crypto with a credit rating. Like we like literally were like trying to model and and like allow others to even like see the risks and like see how it worked and be incredibly like transparent about building a product that like people could get comfortable with, like, what are you doing and how does it work? And then when everybody blew up, just the idea of like, give us your money and like we will like give you more back, even if it was like based on a DeFi protocol under the hood, like using a smart contract that can't steal your money. Like the whole concept of like, give us your money, like seemed ridiculous. And so like, if you're gonna do it, you need like any
sort of give us your money, whether you're raising for a fund, a company, a product, not a great time.
Not a great time for like, give us your money. And so like, that's really like the kernel of the idea that's evolved into Superstate, which is, hey, if you're going to say, give us your money, you need a really well-trod path and like a really clean structure for that. And like, in my mind, the cleanest structure possible is you have a registered investment product with auditors and service providers. And it's like, give your money to a mutual fund. Does not sound scary. Give your money to a mutual fund with cool on-chain components that like evolve is like really actually quite, sound. It's not like give it to a business to like do what they want with. And so I think it's the path that institutions unfortunately are going to have to go down. I think it's like the only thing like tolerable to acquire the next billions of dollars of assets in the crypto ecosystem is, hey, here's an incredibly straightforward, product that you can understand, that's regulated, that there's a lot of professional service providers built around, and that, that the assets are being invested in something straight, simple, and transparent. But it's also composable over time with the crypto ecosystem and why you're here in the first place. And so it's an evolution. It was really sad for Compound Treasury not to work. But it's really exciting.
There's no tougher thing, I think, than shutting down something, whether it's a company or a product or anything that you've been working super hard on for the last couple of years.
I know it was difficult, but I think this new direction is really exciting. Compound Labs has, new management. I
want to commend you, by the way. I actually I don't know Jason. I've been DMing with Jason a little bit, just on Twitter. I think he's going to come on the podcast. We'll have him on soon at some point. But I commend you for putting a product designer in charge of Compound, because of all of the things, the skills basically that are undervalued in crypto today, there's people value engineers, people value BD people value marketers. Product design, I think, is the most undervalued skill set in all of crypto today. And it's something that we need a lot more product designers and a lot better product designers. So I thought it was awesome that you put a product designer in charge.
I completely agree. Jason's, not just a product designer, but just like a great product thinker. And, I think user experience has so far to go in crypto generally that the more people you can empower who are just like, really focused on the user, the better. And, for the last couple of years, he was, really, leading pretty much all of the product at Compound. And so, having him there, I think like they're going to do really cool things.
Awesome. Robert, anything else, man?
I think that's it.
Cool. Always a pleasure, my friend. Hope you enjoy the rest of your day, and best of luck to you in Superstate.
Yeah, thank you. Thanks for having me on the show.